Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. Late to the SUV party, India's largest car maker, Maruti Suzuki, doesn't want to repeat the same mistake for the next big event. In a surprise move on Thursday, the company announced that it will roll out its first electric car in FY24, a full year ahead of schedule, and it will keep on churning out new models every year till 2030. So what prompted Maruti to put its EV project in top gear, and what does it mean for its competitors? Bhaswar Kumar's report gives an overview.
In 2019, when Tata Motors rolled out its first electric car for personal buyers, its competitor and India's largest automaker Maruti Suzuki was still reluctant. It was betting on small cars and hybrids. And in September last year, Maruti chairman R.C. Bhargava said in an interview to a business website, electric vehicles will not become a major product in the market, and the reason is that the small car component of the total market is still very large, at around 70% or so. It is not going to be very easy for electric vehicles to penetrate. At the 2020 Auto Expo in Delhi, Maruti surprised everyone by announcing it would not bring out an electric car. In contrast, Tata Motors was clearly bullish and was banking on multiple EV offerings. Maruti's logic was based on what it saw as the nature of the Indian market, which was dominated by small cars, where affordability was key. According to Maruti, a viable small EV would have to be priced at 8 lakh rupees at most. The state of battery technology in 2020 did not allow that. Back then, Bhargava had also said that in order to reach reasonable volumes, EV batteries would have to be made in India. Eventually, Maruti Suzuki decided to bet on hybrids instead of EVs as part of its green mobility shift. Even in August last year, Bhargava made a strong pitch to the government for incentivizing the use of alternative technologies like hybrids, CNG, ethanol, and biogas for small and affordable cars. This would give consumers in what he called the Bharat market an alternative to costlier EVs. Bhargava's logic was that there were two markets in India: the Bharat market for affordable small cars and a developed market for bigger cars costing up to 25 lakh rupees. Bhargava had also advocated a cut in the goods and services tax on hybrids, as in the case of electric cars, to bring down the former's price to affordable levels. The view that EVs were not the immediate answer to reducing India's carbon emissions had put Bhargava at odds with many of the world's largest car makers, except Toyota, which also saw hybrids as the logical interim step before shifting to pure EVs. However, coming into 2023, Maruti appears to have become more optimistic about EVs. It will launch its first EV next financial year and will roll out 5 more in India by FY30, according to its parent Suzuki. EVs will constitute 15% of Maruti's total production by that year, hybrids 25%, and internal combustion engine-based vehicles 60%. Maruti will launch an electric SUV in FY24. It will be based on the EVX, the concept electric SUV unveiled at Auto Expo 2023. So, why has Maruti finally jumped on the EV bandwagon?
No, I think if you take what Mr. Bhargav said, the context of when Mr. Bhargav said it, it was before the PLI schemes were announced for both the advanced cell chemistry and for EVs. So the context in which he sent it is actually changed. Second, the electric vehicle market, although small in numbers, but it's growing at 484%. So like earlier when Maruti was not in the diesel segment, and when the diesel segment started growing, they came into the diesel segment, or earlier, they were not in the CNG segment. When the CNG segment started growing, they came into the CNG segment. So I think it's a response to how the market dynamics are shaping up, and they found areas in the market where they feel that they're now competitive. And you're also seeing new concepts like battery as a service come in, or other concepts coming in. So the vehicles have become more stable, the technology has become more robust. standards have been put in. So I think the whole ecosystem is evolving at a significantly fast pace, and there's enough space for Maruti as the market stands today.
With alternate fuels, taking mainstream these days, Maruti has also decided to move into alternate fuels. They've spoken about EVs, but they've also spoken about product variants in the CNG sector. I think what they were trying to do is see the maturity curve and then act accordingly. They would have done their internal analysis to figure out maturity at what time in terms of volume, etc. And they believe the timing is right now, and that's why they've gone after it.
Maruti's share of India's domestic passenger vehicle market has fallen from slightly more than 50% in 2019-20, and it may be somewhat late to the party, with Tata Motors dominating the Indian EV market at present with an 85% share. However, Maruti still has considerable size and scale. It had the largest passenger car market share across the country in 2022 at 46%, with Hyundai coming a distant second, followed by Tata Motors. The Indian EV market is also set for greater competition. This year, Chinese-owned British brand MG Motor and China's biggest EV maker BYD are looking to acquire a one-third share of the market. But since retail sales of EVs accounted for less than 5% of total automobile sales in 2022, Maruti still has time to make its mark. So, what will be the impact of Maruti's entry into the Indian EV market and its competitors?
So I think if you look at the market and any new entrants entering into the market, two things happen. One, the market size increases. Two, relative shares actually decrease. But what happens in both the cases, growth rates of companies who are already in the market don't substantially take a hit going forward. So it's not a replacement market, it's a plus market. Yes, as the market matures, if Maruti had not been there, obviously their percentage share would have been distributed amongst the other operators or other OEMs. But I think this is a welcome choice for the consumer and a great step forward for the Indian electric vehicle industry.
Maruti is the leader in the passenger vehicle segment. So them moving into EVs with the reach that they have across the country, with the number of dealers they have, the existing number of customers they have, etc., it'll actually get the inflection point for EVs much quicker with players like Maruti in it, and it could actually be potentially be helpful to other players as well, as the adoption of EVs will be looked at in a sense that across different passenger cars, everybody is jumping into it, and the ecosystem development will take place much faster. So I guess it's a win-win for all.
Clearly, Maruti's entry into the electric passenger car market is a positive development for the EV ecosystem, and also the likes of Tata and Mahindra. But their collective future could still depend on how they meet the increased competition from ambitious Chinese players which enjoy their own scale and deep pockets.
Leaving the rough pandemic year behind, car sales in India broke all the previous records in 2022 as they surged by over 23%. India's public sector banks too were not behind, and they finally turned the corner last year. But it seems a large number of their employees is not happy. Some of their demands include wage revision and a 5-day week. But is a 5-day work model feasible for banks? Tushar Verma explains in this report.
The United Forum of Bank Unions, or UFBU, the umbrella body of 9 public sector banks, had called for a countrywide strike from January 30. However, the strike was deferred as the Indian Banks Association, another body of public sector banks, agreed to hold talks to address the demands. Call for the now deferred strike was a result of a long pending demand for better working conditions by PSU bank employees. This includes introducing a 5-day work week and reversion to the old pension system. However, the immediate demand was to start fresh talks on the 5-year settlement for revision of wages and service conditions. This is because the last 5-year settlement was held in 2017 and its term ended in 2022. In October 2022, PSU bank employee unions proposed the change in working hours to a 5-day work week norm. As compensation for the 2 days weekly off, the unions had proposed to extend daily banking hours by 30 minutes for customer service hours and non-cash transactions. The idea is total working hours remain the same, while employees will have 2 consecutive days off in a week. So, is it time for Indian banks to adopt a 5-day work week norm?
Nowadays, the alternative delivery channels have improved a lot. See, ATM service, digital service, many other apps. So many things have come for payment system. After all, people want to remit their money, and also they want withdraw money. This is the main thing. All other services are available through internet. Internationally, banking has shifted to 5-day. In India also, even money market, foreign exchange market, everything is 5-day. Government works 5 days, state governments work 5 days, Reserve Bank works 5 days. And here, because of the complexity of the increasing banking services, employees are working under a lot of stress during the time. So naturally, there is genuine demand that they need 2 days weekend for recuperation.
Banking experts, on the other hand, emphasize that certain services such as locker services, etc., will get disrupted during the weekend. This is because most people, especially the salaried class, wait for the weekend to fulfill their banking needs. It is pertinent to note that banking services over the weekend require employees to be present in the office, while most banking facilities have now been digitized.
In public sector banking, so many banks had to be merged because the P&L and the balance sheets were so weakened, in fact. So in that backdrop, I can understand the demand for let's say salary hike but such demands like 5-day week, those disrupt the services. Now during that time, it does become a little difficult, for people to cope up with their banking needs, including their lockers, including their savings, withdrawal of their savings, or any banking transaction that they would want to conduct. So in this situation, I suppose to expect reduction of work over the weekend is perhaps not a very, very, very exciting idea, I would say.
According to RBI's annual publication, Statistical Tables Relating to Banks in India for 2021 to 22, the share of employees in public sector banks has reduced. Among scheduled commercial banks, which include both private and public sector banks, the share of PSB employees is almost 50%. This means the demand put forth by the unions will affect half of all bank employees in the country. In a scenario of a strike, banking services in the country will be severely affected for the same reason. Another key demand of the unions is the reversion to old pension system. Union leaders say the current National Pension Scheme or NPS is not in tune with the increasing cost of living. The demand to scrap NPS is expected to benefit post-2010 employees and officers as they are not under the old pension scheme but the NPS.
From 2010 in banks, the new pension scheme, which is linked to the market, that was introduced. Now in the last 10-15 years, it is our experience that is no good for the young people in the sense that the returns on whatever we have saved during this service period in this new pension scheme to be invested, the return is subject to market risk and it is not stable. It is not linked to cost of living. And so we want a stable, maybe X, Y, Z. Amount is not the point. Point is the income must be a stabilized, regular income linked to cost of living. That is available only in the old pension scheme.
The old pension scheme is fraught with RBI cautioning that it may add to fiscal burden of states in the coming years. According to the current budget estimates, states will see a rise of 16% in their pension expenditure, which will touch 4,63,436 crore rupees. So, how reasonable is the demand by the bank unions to revert to the old pension scheme?
The NPS system has performed so very well. Year on year, it has returned, on a benchmark basis, more than even comparable mutual funds. And the reason is very simple. They do not charge as much as the mutual funds do. A large part of the amount of AUM that is with the NPS, by and large, is deployed with sort of secured assets. Mainly the government papers. If you look at the impact of a multiplier, year on year, the new pension system has actually been rendering a much better reward to the employees who wish to go back to, let's say, the old pension system. There's a huge controversy on that. If the banking unions also want to do something like that, that demand perhaps looks to me, as a demand with very little of application of mind, on the part of the unions.
The 5-day work week is seen as a reasonable demand by the unions, considering that banks around the world follow the same schedule. Even the RBI functions 5 days a week. However, the move may affect retail customers for whom weekends are the most suited to fulfill their banking needs. Meanwhile, the other demand for going back to the old pension scheme is aimed at guaranteeing a secured income, but it may come at the cost of stressing state finance.
The exposure of Indian banks to the Adani Group is within manageable limits, global brokerage Jefferies said on Friday. This is even as the conglomerate was trying hard to assuage the nervousness of investors against the backdrop of US short seller Hinsberg Research's negative report. The group's stocks have crashed by over 20% since the report came out. So, will the carnage continue in the days ahead? Or will things improve from here on? Here's what analysts think.
The sell-off in Adani Group stocks over the past couple of sessions has now made analysts wary, who suggest more downside could be in the offing. The free fall in these stocks comes on the heels of a report by US activist investor Hindenburg Research LLC that said it was shorting them. It accused the firms owned by Asia's richest man, Gautam Adani, of brazen market manipulation and accounting fraud. Even if you ignore the findings of our investigation and take the financials of Adani Group at face value, its 7 key listed companies have 85% downside purely on a fundamental basis, owing to sky-high valuations. The Hindenburg Research LLC report said, in the last 2 trading sessions, most Adani Group stocks have lost considerable ground as compared to the frontline indices. On its part, Adani Group has clarified that Hindenburg Research has published this without making any attempt to contact them or verify the factual matrix. The developments, according to market analyst Ambarish Baliga, are now making markets nervous. He suggests more brokerages could now start questioning the firm regarding its financials.
These stocks have only moved one way. If you see overall, okay. If you see in the last 2-3 years, it's moved only one way, although they have been volatile in the recent past. So, with this correction, what you see or what you are seeing now, one can't say it is oversold. It can be oversold in a short term. And see, whatever questions have been asked now, see, no one was really questioning the group. Now, I don't know whether this will start that trend of other analysts also questioning. I don't think one should take a view that, okay, it has fallen because of which you should buy. I think we have to see as to how they respond, because they started responding to the queries. The questions raised, they started responding. Yeah. But, the way they have threatened about legal action and all that, I don't think that has gone really down. It has gone down well with the market. There could be more downside for all you know. See, first of all, these guys are not here. If they were here, it could have gotten over much faster.
Assuaging investor concerns, CLSA and Jefferies have said that the group's debts are at manageable levels and the Indian banking sector is not at risk. According to those at Jefferies, Adani Group has diversified its borrowing mix and reduced the share of Indian banks, PSU and private in their borrowings. from 86% in FY16 to 33% in FY22. The share of bonds as well as foreign banks in total debt has risen to 37% and 18% now. From banking sector's perspective, debt to this group forms 0.5% of total loans, 0.7% for PSU banks and 0.3% for private banks. Repayment timelines of debt have been conservatively planned. While we watch for developments here, we don't see material risk arising to the Indian banking sector, analysts at Jefferies said in a note. Interestingly, the four group stocks listed in the futures and options segment, Adani Enterprises, Adani Ports, ACC and Ambuja Cement, had already witnessed build-up of shorts in the beginning of the last week, that is, couple of days prior to the day the Hindenburg report news broke. In general, a fall in stock price accompanied with rise in open interest, or OI, indicates build-up of short positions in the F&O segment. Adani Enterprises, for instance, saw its open interest rising by as much as 71.3% in the first three sessions in the last week. Data suggests that a pullback, if any, may be capped around 3,350 rupees to 3,400 rupees range for the February series, while the support is seen in the range of 2,550 rupees to 2,600 rupees. Ambuja Cements too had slipped up to 7.7% in the first three trading sessions of the last week. The OI saw a significant jump of 385% during this period. Data suggests that the counter may bounce back above the 400 rupees mark in the near term, though the respite could be short-lived. This week, the markets will keenly eye the union budget proposals to be announced on February 1st and the outcome of the US Fed meet later this week.
Meanwhile, after Singapore, lab-grown meat will now find its way to US restaurants as well in the next few months. Authorities in the United States have found a meat product derived from animal cells to be safe for human consumption. In our Decoded segment, we have more on lab-grown meat.
Last Tuesday, on the outskirts of Hong Kong, a butcher was killed in a freak accident. A pig which he had shot with an electric stun gun suddenly rose and charged, knocking the butcher to the ground. In the ensuing struggle between the man and the animal won. But livestock rarely behave like this and end up being slaughtered for food. Globally, over 1 million cows are slaughtered daily, along with 4 million pigs, 1.5 million lambs, and 1.2 million goats. Millions of farms around the world rear and kill these animals for meat. This process is also one of the largest sources of greenhouse gas emission, much more than the transportation sector. But a ray of hope is emerging from labs. Experts believe that we are on the cusp of a big change. The Food and Drug Administration of the United States cleared a lab-grown meat product developed by a California startup as safe for human consumption in November last year. And according to reports, cell-cultivated meats will be available in supermarkets and restaurants in the US in the next few months. Before the US, Singapore had given its assent to lab-grown meat in 2021, but experts believe that the US approval may turn the fortunes of this sector around and lead to large-scale adoption of lab-grown meat worldwide. A Dutch scientist had exhibited the first lab-grown meat burger on live television in 2013. Since then, over 60 companies are working to perfect this technology and bring down the cost at the same time. But how is this meat developed in labs? Under this process, muscle cells are taken from a buffalo, cow, or a chicken, whichever meat you need. Just like doctors do a biopsy, these cells are then split into pieces and put into a bioreactor which is full of broth. This solution is also called growth medium, which contains protein, vitamins, sugar, salt, etc. And that's it. Under the controlled temperature of labs, these cells start multiplying. Within a week, a large amount of meat is ready for your burger and kebabs. Tons of meat can be produced from just a few cells without killing the animal. Initially, its taste and texture wasn't like real meat, but over the years, scientists have bridged that gap too. While eateries selling soya chap masala or soya kebabs, which are called plant-based meat, are a common sight now, it will be a while before eateries start selling products made of lab-grown meat.
I will achieve. I will nation's trusted bank, SBI, the banker to every Indian.
A 2022 study published in the Journal of Environmental Psychology claimed that 35% of meat eaters would be too disgusted to try the cultivated meat. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll see you tomorrow morning. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.